All right, welcome to the very first AVRY Weekly Brief for our brand new active ETF, ticker AVRY. Before we get started, I wanted to quickly introduce, the AVRY Foundational ETF. Foundational to us really means, three things. First, we're seeking companies that are foundational to their industries. We're seeking industries that are foundational to where the world is headed. And then lastly, we are looking to build a portfolio that is foundational to, global asset allocations. So really those three components, I think, summarize our view and define, the rationale of why we selected, the name AVRY Foundational for our ETF. Our approach here is very much data-driven. We focus on, durable businesses, long-term trends, where fundamentals, I think, meet future opportunities, and letting those two intersect and ultimately, again, staying very much valuation disciplined, not chasing themes and thematic ideas only, but, tying that with a disciplined approach. So this is the weekly brief. You should expect updates like this weekly, sometimes bi-weekly. They'll typically last, somewhere between, 4 to 7 minutes in length. And again, we're excited to launch the active ETF. It's live now. It's trading on the CBOE in a couple of weeks or months. We'll be ringing the bell there. We're really looking forward to that. Each weekly brief, for your own knowledge, will cover a few core areas. One sentence that defines the week, key signals that we saw, where there's more noise than signal overall, any strategy updates, and then finally, what we're watching in the week or two ahead. One important note before I continue, nothing here should be considered a recommendation to buy or sell any securities. Please review the disclaimer and visit our website, AVRYfunds.com. With that, let's get to it. All right, so let's jump into the first section, which is the one sentence that I think defines the week. It was, this week was about AI, but it was about who loses and who loses more. I think there was really no in between. And, I think what stood out, again, it wasn't the product announcements that we saw this week. It wasn't feature releases. It was really just this tug of war between what AI enables and what it costs. And then also the tension of, what's going to happen to incumbents and then also balance sheets. The signals that we saw this week that I think are important to note, number one, Google had its earnings report. I think there's a lot of takeaways there. It's not just cloud or AI or anything like that. It was a little bit of that, but also the signal that can be derived from this. They raised their CapEx to $180 billion. The street was sitting at $120 billion. So that's a $60 billion delta. And to put that in some context, in 2020, Google was doing $60 billion in CapEx in the entire year. So that's the delta between, what the market was expecting or analysts were expecting versus what, they announced that on their earnings call. So big deal. I think, this isn't incremental spend. This is definitely structural in nature, replacing much of their legacy infrastructure, and that is continuing. I think that alone sends two important signals. The magnitude of that CapEx raise should be deemed as, first, Google clearly believes that the economic backdrop is strong enough to support this level of investment. I don't think companies commit capital at this scale if demand is rolling over. Think about it. They have Google Search, which shows, intent. It also shows, what advertisers are spending on, so they can see various categories. So they have a pretty good pulse on the economy, and I don't think they would be massively increasing, their budgets if they saw, a weak economy. So I would take that as signal from the report. I think the second thing is really around the demand they're seeing for AI, not just for their cloud division, which grew 40%, but across the core business as well. I don't think this is just, an experiment in trying to figure it out. I think this is ultimately infrastructure for their core business, but also for some others. I think one note on their business here is you can see that their search business grew 18%, the fastest growth they've seen since 2022. And I think that speaks a lot about, one, the idea that AI isn't necessarily as obvious of a disruptor of, some of these legacy categories. I think everyone believed that Google search was going to be overran by kind of these AI modes and the ChatGPTs of the world, yet we're seeing some of the fastest growth within that segment of Google that they've seen in multiple years since the launch of ChatGPT. So I think the narrative is wrong in many cases, and that's showing up all over the place. There's also the narrative, and it kind of speaks to what I just mentioned, which is SaaS is dead. And I think what we saw here actually was that Sundar Pichai and he's the CEO of Alphabet. He listed out a couple different, I extracted a couple different quotes that he had on the call. And one was, we have a very, very good SaaS customers who are leaders in their respective categories. Then he followed on with that the successful companies are incorporating Gemini, their AI models and Suite deeply into their critical workloads. And then I think this line mattered, just as much, if not more, is that token usage growth was very robust in Q4. So speaking to that, their software customers are using a lot of AI, embedding that within their workflows. So that doesn't sound like software's dying to me. It really sounds like software is evolving. For us at Avery, I think, the takeaway is clear. AI spend remains robust. The economy, at least as implied by, Google's behavior here, looks resilient. We saw that again last week with Meta as well, with revenue growing 30%, at least their guidance. We're investors in Meta. Our belief that we think they're the cleanest, clearest AI beneficiary, given that their product is AI, essentially, in terms of their personalization and recommendation engines that they run. Yet, we just engage with, images and text. But ultimately, AI is the mechanism of serving and delivering that video, image, and text to us. So again, I don't think SaaS is obsolete. I don't think any of that is necessarily true. There's certainly areas that, investors should pay attention to. And that brings us to noise, the noise section. What out there is noise and how should we be thinking about those? So a lot of the noise this week was that software is dead. I don't see that. I saw Paylocity, I saw Atlassian. Again, we're not investors there. No recommendation to do anything with that. But both of those, had pretty healthy earnings results. Again, software vendors serving, different audiences. And, I made a post about that. You can go check that out online, but not for this. So, are there areas of weakness within software? Sure. Single point solution products, I think, can be impacted. I think companies that have limited lock-in, I think companies that have little to no network effects, I think software companies that, aren't embedded into kind of like high governance or compliance heavy, industries could have, impacts. But I think there's a lot of companies out there sitting on, again, proprietary data and are already embedding AI into their workflows, which I think is key and important here. Now, the next part is that the headlines around jobs. So headlines were that, Amazon's cutting jobs, UPS is cutting jobs. When we actually looked at the data, job postings at companies are still outpacing the number of roles being eliminated. So here's kind of, job openings at, Amazon and UPS. And what you see here is 20,000 job openings at Amazon, 4,500 jobs at UPS, very different than what the market's narrative is. So market reacts to these headlines. I think, we try to react to the underlying behavior of companies and the underlying fundamentals of these businesses. Strategy. So, this section, again, is really, what are we doing here? I think the short answer for us is that, there's no changes this week in the portfolio. There's a lot of things to look at. We're in the thick of earnings season. I think we spend a lot of time razor focused on areas of the market that are, doing well, areas of the market that are doing poorly. And ultimately what we're trying to do is, discern, are there any long-term dislocations that are taking effect here, both from a permanent loss of capital risk, so on a risk management side, but also from an opportunistic side. And, obviously we're looking at a lot of things. I think, I have this quote here that I posted, the hardest part of investing isn't finding ideas. It's actually, doing nothing while, allowing your work to play out, letting a thesis develop, letting fundamentals show up, letting valuation close the gap. Activity feels productive, but patient is, more productive in many cases. So that's a little bit of, how we're thinking about the week. Going forward, what are we watching? We're looking ahead. Here's what we're watching, but I think on one side, we're looking at software. You can see the index here, IGV, hitting its, April low bottoms as a index. And I think this is kind of the head of the spear when you think of, some of the concerns in the market. So we saw a massive volume, somewhat capitulation looking, trading activity in software. And I think ultimately, if we can stabilize and bottom here, that could be, a good signal to, forward-looking market moves. We have more earnings next week. Here's just a calendar from, Earnings Whisper. And, many companies are reporting next week. So we'll get more insights on, what ultimately is happening for companies, specifically software companies, given that is top of mind for many. But, much of the data we track is more positive than negative as it relates to, software and AI. And ultimately, I think there's going to be more AI and more software versus less software because of AI. So I think that ultimately is our view there. Last but not least,